Kevin here. In this video, I'm going to give you a no-nonsense explanation of what my stock market investing strategy has been and whether or not I think we're in a bubble and my favorite stock picks for the time being. Now, no guarantees that these will be successful for you going forward, but let's be real. I've been plowing money into the stock market since the bottom of the market on March 23rd, and I'm going to pop up here an M1 Finance portfolio. I'm going to blur out the actual stock names because, well, that would kind of give away some of the parts of the video that we're going to talk about. But anyway, as you can see, this M1 Finance account that I opened this year has obviously done very well. It's returned 47.7%, which on this portfolio is about $1.2 million. Now, I do also personally love using the Webull app, which you should use as well because this video is sponsored by Webull. If you open an account with Webull, you will get 2 completely free stocks as long as you deposit $100. But for now, let's get into the topic of the video. Here's how I'm going to break this video down. First, I'm going to give you some background that's very important for understanding the rest of what's going on. Then I'm going to explain what I believe is currently happening. Then I'm going to talk about my 7 favorite stocks and why I'm investing in them so heavily, as well as some of the more risky ones. Then I'm going to explain whether or not we are in a bubble, in my opinion. All right, let's get started. First, let me start with the stock market and what's changed. As some of you might think that this initial part sounds a little redundant, but I encourage you to listen to it because of the big change that happened. So you have to understand some of this little baseline first. Here's the baseline. There are 2 real types of stocks in the kind of economy that we're in right now. There are recession stocks and there are recovery stocks. Recession stocks are stocks that do well in a recession. Zoom, Apple, Tesla, technology companies, Walmart, Apple, whatever. Chipotle's even in there. I honestly, whatever, it's in there. Then you've got the recovery stocks. Those are companies like the traditional restaurants, airlines, cruise lines, travel, hotels, casinos, the Simon Property Group, the Dave & Buster's. Those are the recovery stocks. In March, April, and the first half of May, we could really play either of these. It didn't matter what we were buying because everything was kind of what we called a barbell. That is, you kind of go to lift up a barbell, oh, it's really heavy, and it's kind of leaning to one side one day, and then it's leaning to the other side the next day, but all in all, you're kind of still lifting it up unless there's that April 3rd double dip we saw a little bit, and then kind of things went back up. That was kind of what the market was like. So it didn't matter which side you were on. In fact, if you had a little bit over here and a little bit over here, it made you have less heart palpitations and made you feel like you didn't need life insurance, like what you can get in the link down below. But the problem is things changed. It's kind of like the weights on the recovery stocks, the airlines, the cruise lines, and the travel groups kind of fell onto the floor and spilled onto the floor. And then that kind of got lifted up by more and more defying gravity tech stocks. That is, the tech stocks and all the recession-based stocks are just blowing the lids out of everybody's earnings targets and price targets. And because of that, at the end of May and the beginning of June, I stopped investing in the recovery stocks. I stopped putting new money into the Simon Property Group, the Dave & Buster's, and things like that. I shuffled around a little bit of money, but I stopped putting new money into those because I saw that tech was just jumping past everything else. And here's why I think we're seeing what we're seeing now. Number 1, we're seeing a flight to safety. Everybody who's been holding on to the recovery stocks, the Dave & Buster's, the airlines, the restaurants, right now is FOMOing hard because the tech stocks are doing so well. And so I believe a lot of people are moving over from these to the tech stocks, leading to new highs at the tech stocks. Again, Amazon, Apple, Tesla, right? I mean, Tesla's like over $1,300. It's been 3 days in a row of over 10% gains at Tesla. It's insane. The second problem is the people who have been sitting on the sidelines, who have been waiting for a double dip, are possibly starting to realize that, okay, maybe there's not going to be a double dip. Maybe now's the time to get in. Okay, well, what am I going to buy? I don't know. Do I want to buy, the untouchables, like the restaurants or the Dave & Buster's? Or do I want to buy what's been doing really freaking well? The Tesla, the Etsy, and the Amazon, and so on. And I think that's exactly what people are doing. And third, obviously, can't have a video about stocks without talking about the money printer. The Fed's injection into the market has been so unprecedented that we're starting to see the massive available cash pile flowing right kind of into the market, aka the stock market. It's kind of like the rich get richer, right? And that's why it's so frustrating to see this kind of stimulus happen for the market and for big corporations, for big companies, and poor people get left behind. It's not fair. It's people without assets are getting screwed in situations like this. Pandemics make poor people poorer. Recessions make poor people poorer. And rich people more, it doesn't make sense. Anyway, now, many of you in my course already know a lot of what I'm talking about because I talk about this every single day in the live streams. As it's happening, I tell you what my changes are. Anyway, let's keep going on for those of you that aren't in that. So if you're a course member, sorry, some of this might already sound familiar. Now, the untouchables, like Dave & Buster's, the cruise lines, and the airlines, and so on and so forth, right now, they're pretty dirty, and they've been weighed down a lot. They are massively on sale. And you'd think that more money would flow into these, but the reality is, right now, a lot of hedge funds and people are looking at the dirty, untouchable companies, and they're saying, you know what? We have bankruptcy risks. We have risks of restructuring. We have risks of share dilution, that is issuing more shares, which makes my shares less valuable. We have risks of long-term struggles paying off all this fat debt. Nobody even cares anymore if the Main Street loan program comes around when bars in Miami keep getting reclosed and we're de-opening is the phrase now, I guess. How are these companies ever supposed to be profitable again? And so this is why we're getting so much of this money consolidating, in my opinion, into what already seem like very expensive companies. And that's a very fair complaint that comes up too. Why are valuations so high? Valuations at tech companies are historically way high. I mean, everything we look at, it's like everything's overvalued. And right now, it's quite frankly, in my opinion, because the fundamentals aren't what matter right now, which is terrible. Like me just saying that, the fundamentals aren't what matter right now, terrible. It's a bad way to invest. The reality is that's a bad way to invest, in my opinion. But the reason that is doing so well right now, that is ignoring the fundamentals and focusing on tech and safety, is solely because of safety. Where are you guaranteed to do well, whether or not there is a pandemic? In the tech sector. Where are you probably pretty much guaranteed to do well over the long run? In the tech sector. So what you're really doing is you're paying a premium and you're really paying to play right now. And that's why hedge funds and investors are bending over, basically jumping into these tech stocks, because bonds are yielding nothing, savings are yielding nothing, and anybody who's holding the untouchables is pulling their hair out because the untouchable airlines and cruise lines and restaurant groups are falling way behind. Every dollar you have in one of the losers right now is sucking compared to Apple that reaches a new high every day, Shopify, Etsy, whatever. And again, it makes sense because we're in a pandemic. These companies, they don't face bankruptcy risks and they're going to be here whether or not there's a pandemic. That makes them safer plays. And I think there are a lot of people who are looking for what is a safe option right now. And it's not bonds, it's not savings, and it's not Dave & Buster's because that's risky. Even though that has a better chance of, 2 to 3xing faster than Tesla might, although who knows at this rate, Tesla and Amazon and the big tech companies are where people at least feel like they have safety right now. That does not mean that there actually is safety. There could be a rebalancing and a reversion to the fundamentals, and then prices might come substantially down. We'll see. But let's talk about what's happening now and what I'm doing with my portfolio. So first, in the middle of May, I removed some of my recovery holdings into Simon Property Group. I got rid of Delta and I moved that into Simon because they're sister companies. I talk about that in the Money and Stock course, how I track sister companies and stuff like that. Carnival's another one that's a sister company as well with like Dave & Buster's, for example. But I also put some of my portfolio into Dave & Buster's, and all in all, I had somewhere around 15% at the end of May of my portfolio in Dave & Buster's and the Simon Property Group. That means 85% of my portfolio was in these tech companies, which is why the gains are what they are on my portfolio. The vast majority of my portfolio has been based on these very well-performing, at least recently, tech companies. Now, they could totally collapse going forward, but we will see. Let's now, in the meantime, talk about some specific stock picks, why I like them, and what I'm doing from here on, because it's easy to talk about the past. It's hard to try to understand what the future might look like. Number 1, Lemonade. Lemonade is an insurance company that I announced on their IPO day last Friday in my course, and I even mentioned it on our stimulus videos that I was buying into that company. I bought in right when the market opened at around $55 per share. It's now somewhere around $80 per share, and it went as high as like 92, which this is so normal to see this kind of volatility on an IPO. Very, very, very normal. Lemonade is an insurance company, but rather than investing in an insurance company that goes and invests kind of the money, the insurance float that they have, where you're kind of subject to the claim cycle, Lemonade, in my opinion, is a bit different. I spent the weekend reading their earnings report in addition to what I read on Friday, and this is a company that really is focused on customer acquisition and artificial intelligence to determine the likelihood of claims. For example, and this was mind-blowing, but when you go through the application process, you're given a copy of their terms of services. Like, here are the terms of services. And since it's all electronic, you're supposed to click on it, right? But most of us don't. They factor your decision as to whether or not you actually read the terms of services into your policy's likelihood of having a claim. That's insane. They use the same artificial intelligence to pay claims, detect fraud, and write policies. They also make it very easy to determine what kind of options you want for your policy, which is really friendly for people who don't fully understand insurance. It makes it very easy to say, oh yeah, I'll pay $5 more a month for that, or $5 more a month for that, and it's a great way to incrementally increase the profit the insurance company can make. Unfortunately, they don't do rental properties yet. They just do like renters insurance and homeowners insurance and are coming out with pet insurance, but they boast having a very strong retention base specifically from millennials. That is, of the millennials and the people that use Lemonade, 90% of them say that they're not going to leave, and this is proven by the data that Lemonade already has. They have a very strong retention rate. This is really important because Lemonade spends a lot of money on marketing. That's why the company looks like it's losing so much money. And it doesn't really look like it's losing a lot of money. It is losing money. But the money that they spend in marketing pays for itself within about 2 years, which is a very quick return. And if they can maintain the long-term retention and customer satisfaction, this insurance company has the possibility of being a very, very good growth company to invest in. Now, as with any IPO, it's high risk. So unless you're interested in high risk, this is not a company to invest in. Heck, if you're interested in high risk, you probably like Dave & Buster's. In my opinion, if you want low risk, you go with like an Apple. Super cash heavy, maybe less growth to come in the future, but a great solid company, or just park it in an index fund. I guess if you really wanted risk and fluctuation, you could go buy Bitcoin. Although some people would argue with me on that and say that Bitcoin is less risky than some of these stocks, but I guess that's a debate for a different day and over a nice ice cold schooner of beer when the bars finally open up again. But anyway, this company also expects to add new policy options in the future, and they offload 75% of their risk through reinsurance. Their goal is really to have a predictable stream of profit, which the cool thing about that is it's gonna make my life easy. I don't have to do crazy adjustments and trying to value the company. Now again, the company's lost money and in their initial prospectus. So for me, this company is a 10-year hold, no sell during that 10 years. We'll see. It's a company that I'm bullish on. We will see. They do have share dilution happening in January, so mark your calendar for January. There are not a lot of shares outstanding right now. I think we've got about 11 million shares outstanding right now out of about 55 million that are supposed to be outstanding. Now, unlike Nikola, though, there is a 180-day ban on when these extra shares could be sold, so that's good. Speaking of Nikola, Nikola is getting whacked today. They're down almost 14%, and this is what happens when PIPE investors get approval to sell their shares, and they all of a sudden start flooding the market with a bunch more shares. Who knows? This might create a buying opportunity for Nikola stock, though. Number 2 favorite, Tesla. When Tesla hits $2 million vehicles produced, in my opinion, its fair value is about $2,000 for the stock. That is 2 million cars produced, $2,000 for the stock value. That's at about 40 times earnings, not even including Tesla Solar or Tesla Insurance. Tesla Solar is becoming the staple for the company, and it's barely even mentioned. It's innovating the solar lease systems that they have where you can cancel at any time. I've been looking into getting Tesla Solar. The customer service is phenomenal. It's just right up there with the car's customer service, which I will say at first, Tesla customer service, it had some issues, okay? There were some quality control problems. but the increasing propensity of this company to get better and better every single day is absolutely astonishing, and I expect their solar roofs to be massively profitable as well. Tesla insurance also stands to be cheaper than the competitors and doesn't really compete with Lemonade because this is car insurance and they don't do car insurance. But anyway, Tesla only insures their own product, and their product is based on their artificial intelligence, that is their self-driving cars, which Tesla has 3 billion miles of autonomous driving on actual roads, not in simulations. Google's Waymo is in number 2 at 20 million miles, which means Tesla is 150 times as far along in terms of autonomous driving as Google is in terms of miles driven on actual roads. So, Tesla, 10-year, no sell for me. Number 3 is Etsy. Etsy is a relatively affordable stock next to the insanely priced Shopify and Wayfair. Etsy has seen tremendous gains during the lockdown as small businesses across the country are shut down or struggling. Etsy, well, has been the outlet for those small businesses who are struggling. Etsy doesn't rely on the heavy furniture shipping industry, and it's easy for small businesses to get a start on Etsy, which makes Etsy a favorite for me. I originally bought Etsy heavily in the 70s, and I have a target of about $130 per share for Etsy, but this is actually with a richer valuation than Tesla, but it's a much lower valuation than Shopify or Wayfair. So I haven't been adding incredibly heavily to Etsy, but Etsy is a good portion of my portfolio, although if I were going to add today, as crazy as this sounds, I'd probably rather add to Lemonade or Tesla, although I do still love Etsy and I will not leave them behind. Number 4 is Redfin. Redfin stands to be the largest disruptor to real estate agents. And as a real estate broker, in case you don't know, I'm a real estate broker, I got my face on my car, okay? I first started investing in Redfin as a way to hedge against myself going bankrupt because of Redfin. That is, if Redfin did so well that I ended up going bankrupt, at least my Redfin stock was probably doing well. That's when I started being interested in investing in Redfin. And I personally think the transition to Redfin as being a domination in the real estate space is still 5 to 10 years away. But the thing is, Redfin knows how to sell. Being a broker, I shake my head at how many agents are too cheap to get a professional photographer, do proper listing prep, and to fix up the properties before they sell them, let alone do 3D scans. Redfin does all of that and at a lower price than what agents usually charge. This is going to be very, very popular with millennials who are delaying home ownership, which again delays how long I think it'll be until, well, Redfin becomes much more dominant. Unless, of course, agents start picking up the slack and providing more value. Or maybe that's just what I teach in my real estate agent course, where I teach you how to use the trademarked slogan, providing more and no pressure agent. Anyway, Redfin is going to dominate the real estate space at some point within this next decade, especially since I'm calling this the frugal decade. That's my opinion. Now, pricing Redfin is a little bit more difficult. I initially bought Redfin heavily at 17, a little bit at 10, and some in the high 20s, a little bit in the low 30s. Obviously now they're priced at about $43. So, big win so far, but in my opinion, the big win is coming when Redfin has the ability to automate home showings. We know this is just a matter of time. Think about it. You open up the Redfin app. They've already got your ID. They've got your pre-approval letter. They're already doing Redfin loans. So you've got everything on your phone. In theory, you could walk into a house, and I'm speculating here, but I see this happening. You take your phone, swab it over a lockbox, the house unlocks, you go in, honey, I like this home, you click a button on your phone, and boom, you just made an offer on it. That's my expectation for the future of real estate, and that is not what the real estate agents who follow me are going to want to hear, but it's what you need to hear. Because if you don't pay attention to your risk factors, you're lying to yourself, and I'd rather be upfront and honest. Now, pay attention to this company. It's a great company. The CEO, Glenn Kelman, is a very smart person, and people at this company are brilliant. And as much as I love to hate the company because I'm a real estate broker, I invest in it. This is a 10-year no sell for me. Number 5, Peloton. Okay, all right. This one's I'm a little mixed on this one, okay? Peloton is a home exercise treadmill and bike manufacturer. They actually stopped manufacturing their treadmill, even though that's what I wanted during the pandemic, because they're worried that they can't socially distance install the treadmills because they're too heavy. I don't know. It's mind-blowing to me. They're only selling the bike is the bottom line right now. They basically have this popular app, the Peloton app, that you could use to train with fitness pros virtually. And you could work out with them in groups and do voice chats and this, that, or whatever. One of the things I hate about the company is the fact that their app is so closed source. It's not like, it's kind of like the Apple iPhone when it first came out. You couldn't put any different apps on it. I can't watch Netflix on my Peloton bike because they lock you into their system, and that drives me nuts. That really grinds my gears. Now, they have released the Peloton app for other devices like Roku and the Apple App Store, so you could put the app on your iPad and not have to buy the expensive bike. Because the bike's like $2,500. Now, they give you 30 days to return it, but if you go on Amazon, I could literally take this iPad that I got right here and pop it onto an exercise bike that I could buy off Amazon for like $380. Why am I gonna spend $2,500 on a bike? I don't know, but people are. And so I started buying the Peloton bike in the high 30s. I missed out on the dip when it went down to the 19, but now it's at about 60. Now, Peloton should smash earnings coming up, unless this is already expected and built in, which it could be, and then I'd be wrong. But I believe they might smash earnings because the latest earnings reports all rely heavily on Peloton selling their bikes and equipment through salespeople in malls, which means they have to pay like 50% in commissions to those people. Well, guess what hasn't been happening? Malls and sales in malls because, well, we're in a pandemic. Instead, Peloton has been benefited from viral marketing that's really, it should be showing up in their bottom line here. That is, they've been able to have sales and attention go to their website because of the pandemic without needing salespeople to drive that business, which means they don't have to pay the salespeople the 50% cut, which means a lot more money should go to the Peloton bottom line. That is, of course, unless Peloton either becomes a fad and people start canceling their orders, or if Peloton has supply chain issues. It already takes like 6 weeks to get a Peloton bike, which is crazy. Peloton is blowing Nordic out of the way and some of the other competitors. Peloton is standing out above the entire crowd. Sure, Lululemon is trying to get into the game now with their acquisition of the Mirror for, I think, $500 million, but there's a lot to be desired when you compete against Peloton. So keep an eye on Peloton. Now, number 6 and number 7, I'm gonna keep these short because number 6 and 7, come on, we know these companies, okay? We don't need an explanation on these companies. Amazon. This is another 10-year no sell for me. I have a $3,200 price target on them. Amazon is my second largest holding, and well, like I said, Amazon needs no introduction. The same actually goes for Apple. Apple I see as a stable, safer bet. They've got the brand value, they've got the stability, and they've got the cold, hard cash, which allows them to innovate when they want. Although you kind of wonder, like, where's the innovation? We'll see. Now they're trying to replace Intel and do their own vertical integration. Maybe that'll increase cash flows. I don't know. This Mac right here has been a lemon, and that was not a cheap Mac. But anyway, let's now touch on the Simon Property Group, Dave & Buster's, and Cheesecake Factory. Here's the thing. I've been waiting desperately to hear that Dave & Buster's and the Cheesecake Factory have had access to the Main Street Lending Program. As soon as I hear that these companies apply for the Main Street Lending Program, I'll probably invest more money into Dave & Buster's and Cheesecake, because I believe Cheesecake Factory can double, and I believe Dave & Buster's can triple. The problem is, Main Street loans don't let you refinance high interest rate debt. You also have to repay that money from the Federal Reserve. It's the Federal Reserve stimulus money for big companies within 5 years, which is kind of a short fuse to pay back all of that debt coming out of a pandemic and trying to get people back into the habit of going to restaurants and going to Dave & Buster's. So even though the loan might be a lifeline, some of these companies might honestly just be smarter to file bankruptcy, screw the shareholders, and start over. Now, do I really think Cheesecake and Dave & Buster's are going to go bankrupt? Probably not, but look at this, okay? As of Q1, this isn't even the latest earnings report, this is as of the end of March, Q1 2020, the Cheesecake Factory had $507 million in current debts due within the next years. Now, granted, half of that was for gift cards and leases, and the Cheesecake Factory stopped paying their lease agreements, and I'm assuming a lot of people probably aren't using their gift cards, so maybe that's not so bad, but they've only got $270 million in current assets as of the end of March. Now, on top of that, they consider most of their assets to be long-term leases. But the problem is, they just defaulted on most of their long-term leases. So how bad this is going to look in Q2, it remains to be seen. Now, Dave & Buster's has almost $900 million in actual assets, not just leases. They have another about billion in actual leases. Dave & Buster's, this $900 million of assets probably has to do with their gaming machines because, well, they have a whole gaming section as part of their restaurant, right? But both Cheesecake and Dave & Buster's do have that potential to double, even potentially triple. And the problem is, these are hot potatoes. We don't know. They're speculative bets, and when I say they're speculative bets, you should only put a speculative amount of money into them if you actually believe in the companies. Both the Cheesecake Factory and Dave & Buster's are great companies. I personally prefer Dave & Buster's. I think it has a higher potential to pop even higher than the Cheesecake Factory, and I think it's a better company than the Cheesecake Factory. But my opinion on the company isn't going to change the fact that if bars and restaurants continue to get shut down and closed, both of these companies might end up filing bankruptcy. Now, I guess the real question is, do I believe we're in a stock market bubble? Is this the beginning of the end? And in my opinion, the answer is, in the medium term, no. I don't believe in the medium term, when I say that, I mean like 2 to 3 years, that we're in a bubble. As long as interest rates stay this low and bond yields remain as low as they are, interest rates, right? And taking into account the trillions of dollars in stimulus that has been injected into the market, yeah, we've escaped fundamentals, but what we're seeing today is expected. It's an expected flight to safety. Is it sustainable? No, it's only as sustainable as, well, more stimulus comes into the market, which right now it's quite possible that the market is pricing in some expectation of future stimulus, which we could see a dramatic pullback if that stimulus does not come or interest rates go up. Now, my expectation is we're not going to see a dramatic pullback, and there will always be red days, don't get me wrong, and those are good days to go shopping on instead of these crazy euphoric green days. But come 2023 or whenever rates start ticking up, that's when we're going to start, in my opinion, seeing some of this deflating, at least me here in 2020 looking forward 3 years. Obviously, more information will help us guide our decisions, but for the meantime, I would rather be in the market than not in the market. And that's what I've said for years. Just like I've said forever now, make sure to get your life insurance in the link below and your 2 free stocks with the stock trading app Webull. Deposit just $100 and get 2 free stocks. And there you go. If you like this video, consider sharing this because sharing is caring. Folks, I look forward to seeing you in the next video. Let me know your thoughts in the comments down below. I look forward to hearing them. And folks, we will see you soon.